This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Hello, everyone, and welcome to the Financial Standard podcast. My name is Eliza Baven, and I'm a senior journalist here with Financial Standard. Fixed income ETFs have been experiencing rapid growth in the Australian market, with a 40% annual growth rate. Valued at around $28 billion, they now constitute 14% of the ETF market, double their share from a decade ago. In 2023, inflows into these ETFs even matched those into equity ETFs for the first time, according to research from Global X. So in light of this growth and the opportunities in the fixed income space, I'm pleased to welcome Global X's Manny Damianakis to the show. Welcome, Manny.
Thanks, Eliza. Good to be here.
So let's first talk about the growth we've seen in this space. Why do you think investors have been flocking to fixed income ETFs specifically?
Look, I don't think it's a surprise to us anyway that there's been a lot of growth in fixed income ETFs. Traditionally, if you look at where the funds or the wealth in Australia is, it's traditionally concentrated around pre-retiree and those in retirement. So whilst there's a need for growth and exchange-traded funds kind of launched in equity-based products, often investors would buy direct shares and ETFs for their growth portfolio, and then they typically hold fixed income or defensive investments outside of that system because it just actually wasn't a lot available. So you'd see things like cash, term deposits, even bonds outside of the exchange. Whereas over the last, particularly the last 5 years, we've seen a lot more choice. So it just makes a lot of sense to house income and defensive assets alongside their growth assets in shares. So I think it's a combination of definitely investor demand. And I think if you really look at it, a lot of people don't want to have all of their investments in equity or at-risk assets. They do want to house and get income from their investments. So that's probably a bunch of different things have seen that growth.
And how can fixed income investments provide tools for income generation, capital preservation, and diversification in a portfolio?
Yeah, so like I was saying, if you think about ETFs and what they fundamentally do, you can buy, through one trade, you can access a whole array of different investments that sit underneath an ETF. Having fixed income ETFs simply provides that through the same vehicle. So in the past, as I said, you see banks really like a lot of investors because if you think about the margin that banks make on cash deposits or even term deposits, that's really good for the banks. It's not necessarily good for the end investor purchasing those vehicles. So having an ETF then allows us as a provider, like for instance, with our recent bank ETF, you can have different fixed income instruments in the one trade. So you can have things like subordinated notes, bank bonds, hybrid securities, all of which you probably had to buy directly. And there's a bit of administration and effort on that. Now you can just buy them through an exchange traded fund. So I think that's something that makes them very attractive and it does provide diversification through one investment.
And obviously, we've been dealing with a high interest rate environment for the past couple of years now. How have higher rates made fixed income more attractive? But also, as we start heading into an easing cycle, which the US Federal Reserve has been indicating that we're about to, is that going to change? Is the time past now for fixed income to seem attractive?
No, definitely. If anything, that this juncture we're at makes particularly diversified portfolios and exchange-traded products more attractive because it is difficult whilst there is discussions of where rates will go from here. Obviously, you can see there's differences of point of view on that. And a really good example is just recently, there's the market in Australia, the bond market in Australia is pricing in a 25 basis point cut in Australia. But we also saw last week the banks reducing their term deposit rates by in the vicinity of 60 to 80 basis points. So what we would argue is now, because there's a bit of conjecture around timing and direction on interest rates, a portfolio that has some duration, so has some bonds, has some floating rate notes, some shorter term interest securities, because you never really everyone wants to get it right, timing, when to buy bonds, when to sell bonds, when to take on duration, when to put it off. But we think if you buy an ETF that has a componentry of all of that, you're getting now with interest rates being pretty high, you're getting some nice income, but you're also getting some cushioning. If there are some rate rises, you will see some capital gains on the bonds in the portfolio.
Well, that is also kind of the thing when it comes to interest rates. I feel that the market tends to price a lot of stuff in, and whether or not it actually eventuates is something completely different. I mean, if you look back to the beginning of this year, there was plenty of economists who were saying rates are going to be cut in June, July. And now we're here and people are saying, oh, maybe in September, maybe towards the end of the year. So how much does that kind of affect the fixed income space? Is it very much forward looking?
Oh, look, there's absolutely, it is forward looking. And then it allows, I suppose, if you look at different parts of the bond market, there's obviously for those, and we launched a US Treasury bond ETF last year, and that's obviously got longer. US securities typically have longer dated duration than they do in Australia. So if you're in the camp that rates will get cut aggressively, then you want to put on as much duration as possible. So I'd actually look and say, look, that you can express that there's a lot priced into bond markets, but also they're still quite sensitive at that longer end if things change in the short run. So we could see changes in inflation expectations. It's not that the bond market moves very quickly, I think is the way I'd say it. So that's why I think having a diversified exposure, going back to my earlier point, everyone likes to think that they can be ahead of the curve or understand what's going on, but bond markets do move pretty quickly and are quite efficient in pricing that in. So you are right. They are efficient, but then that's why you do need to have a parcel of different ETFs and fixed income securities in your portfolio.
And so what advice would you suggest to investors who might be looking to integrate fixed income ETFs into client portfolios, given the current market conditions? Because as you just touched on, bond markets can kind of go up and down. There's a bit of volatility there. Do you think that there's anything in particular that people should take into consideration?
I guess it comes down to how actively they want to manage those positions. So as I mentioned earlier, you can buy US Treasury ETFs. You can buy specific parts of the bond, so you can look at taking more credit risk through either sub-investment grade credit. If you want to be very active, you can use a bunch of ETFs to play that and have ones with longer duration, higher credit quality, or you can go higher income but maybe more credit risk. So if you can use those ETFs as a part of an active portfolio. But I'd actually think if you're just going back to why do a lot of investors hold fixed income? It's for defense, it's for income. So you can buy a more broad-based ETF, which gives you a bit of everything, and just hold that. And then you get the income. And yes, sometimes if rates move up, then the bonds come off a little bit. But if rates come down, then you get some capital appreciation on bonds. So I think it really comes down to how involved and engaged you want to be. My experience with financial advisors is typically they are less active around how they manage those fixed income parts of the portfolio. They typically do run more of a, not set and forget, but certainly they're not trading that as much as they would on the growth and equity side of the portfolio.
Why do you think that is?
I mean, I think fixed income's interesting. It's kind of, again, depends on your background. I found a lot of financial planners, they just are not, it just seems as though, I don't know, it's probably just, there's less moving parts to fixed income. You got credit risk, your income, duration. So, whereas in equities, there is a lot. You can look at large, small, mid cap, value, growth, sector based, country based. So I think there's a plethora of choice on the growth side, and as you pointed out earlier, we are seeing more choice in fixed income, but it's probably still not at that. I don't think it's capturing the imagination of the advice community, but also fixed income's kind of there. If you think about it, I always say to a lot of advisors, you don't really want fixed income to be the best performing part of your portfolio either. It's kind of a sign usually that it's defense, it's there to mitigate risks. So at the moment, we've had really good equity markets for some time, so bonds haven't really been as in focus. But now that bond yields are higher, obviously, there's been a bit more volatility this year in equity markets. I do think there's going to be more, I think advisors now, we're starting to see this with our bank ETF particularly, we're getting more inbound inquiries from advisors on that. So maybe the tide's turning. Maybe advisors are looking more at fixed income now than they would have been some years ago.
All right, well, Manny, that was all the questions I had for you today. Thank you so much for joining us.
Thanks, good to be here. Thank you.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.